We're tracking two identical guys today. Same age, exact same city, and they both have exactly 50 grand sitting in the bank. One buys a rental property, the other dumps every penny into index funds. We're skipping the generic banter today to dive straight into the unvarnished math of their 20-year wealth journeys. Two people start with the exact same amount of money. One buys a house, the other invests in stocks. 20 years later, one of them is secretly far wealthier, and it's probably not who you think. If you map this out chronologically over 2 decades, the massive gap in hidden friction and actual real-world math is going to make your stomach drop. So let's look at day 1. Jake takes his 50 grand and uses it as a 20% down payment on a $250,000 rental property. The psychological difference right out of the gate is massive. Jake gets a tangible asset. He gets physical keys. And you know, he gets that social proof at dinner parties. People love hearing about real estate. But then there's Marcus. He drops his 50 grand into invisible index funds and sets up an auto transfer of $300 a month. It is an entirely boring reality. No tenants, no keys, just invisible numbers on a screen that literally no one cares about. But as we'll see, feelings and math are two very different things. As you're watching this, you're probably enjoying the breakdown. You can continue watching more explainers like this by subscribing to our channel and following our Facebook page. Also, to help us understand the reach of this video, we'd love to know where you're watching from. Comment the name of your city and the time you're watching this explainer. Now, back to the story. Section 1, Year 3, the hidden spreadsheet reality. Let's see how this builds, because this is exactly where the whole fantasy of passive income crashes straight into hard math. On paper, Jake is totally crushing it. Over 36 months, he's pulled in almost 65 grand in gross rent. Subtract his mortgage, and he's staring at this incredibly impressive-sounding gross cash flow of $16,920. Sounds great, right? But before Jake gets to keep a single dime of that, the real world hits hard. We have to aggressively subtract the actual costs. Subtract $9,000 for property taxes. Subtract $4,500 for insurance. Then factor in a month of vacancy, turnover fees, a sudden $1,200 water heater blowout, and a $2,800 roof leak that conveniently happens right on a holiday weekend. So, go ahead and cross out that gross profit number entirely. It is completely gone. When the dust actually settles, Jake's net cash flow drops to a measly 2 grand over 3 whole years. What this really means is, he's effectively working a part-time landlord job for free. Meanwhile, layer Marcus over this at year 3. Assuming historical market averages, his invisible portfolio hits $76,000. Hours managed? 0. Late-night emergencies? 0. He hasn't lost a single lunch break coordinating plumbers. His money is just quietly compounding. So, stocks win easily, right? Section 2, Year 10, and the leverage counterpunch. Just when it sounds like index funds are running away with the trophy, we hit a massive pivot in the math. The crucial point here is that real estate has an ultimate superpower, and it's called 5-to-1 leverage. Jake used $50,000 of his own money, sure, but he controls a massive $250,000 asset. He is using the bank's money to aggressively accelerate his equity on the entire house, not just his initial down payment. This is a massive game changer that stock investors just cannot safely replicate. And that changes the race fundamentally at the decade mark. Jake's equity swells to between $170,000 and $184,000. He actually pulls slightly ahead of Marcus, whose portfolio is sitting around 165 to 180 grand. It completely flips the script purely because of that leverage. Jake takes the lead, even with all of those exhausting property expenses. Section 3, Year 20, the climax and the scale surprise. Let's fast forward to where the compounding math kicks into overdrive. We look at the balance sheets at year 20, and both guys arrive at the exact same mountaintop. They're sitting at roughly identical net worths, somewhere right in the ballpark of $400,000 to $500,000. But how they arrived at this destination is vastly different. We're talking massive physical effort for Jake versus literally zero physical effort for Marcus. Now here is the final dramatic twist: scalability. If Marcus decides to scale up by adding just $200 more a month, picture the compounding curve going completely parabolic. His wealth absolutely explodes to around $600,000, and it takes him maybe 3 clicks of a mouse to do it. In stark contrast, look at what it takes for Jake to double his investment. He has to take on the massive grinding friction of hunting for a second house, swallowing huge amounts of new bank debt, and literally doubling his weekend workload overnight. Scaling real estate is an exhausting physical act. Section 4. The brutal stock reality. To keep this strictly objective, we have to talk about the terrifying downsides of the market, because it is not all frictionless wealth. We have to admit the brutal reality Marcus faced. He had to swallow gut-wrenching volatility. The market tanked 37% in 2008. It plunged 34% in a single month in 2020, and that is horrifying. To watch your life savings drop by a third in mere weeks. Plus, Marcus gets virtually zero cash flow today to replace his income, and he faces the very real psychological risk of panic selling when the screen bleeds red. Furthermore, stock investors get absolutely none of the powerful, perfectly legal tax write-offs that real estate investors enjoy. Through magic loopholes like depreciation, Jake gets to literally deduct the theoretical physical decline of his building from his taxable income, even while the actual market value of the property goes up. That is pure tax magic that Marcus simply doesn't have access to. Section 5. The ultimate wealth philosophy. So, what is the ultimate philosophical conclusion from this entire 20-year explainer? Who actually won? The math proves both paths absolutely work, but they demand entirely different sacrifices. Jake worked for his wealth. He ran a high-yield, part-time business with massive friction and stress. And Marcus? Marcus waited for his wealth. He traded tangible control for the ultimate ease of liquid freedom, but at the cost of swallowing terrifying market swings. Which leaves us with the only question that matters for your own financial journey. Both paths work, but they both have a distinct cost. Are you looking for a second job that builds immense leveraged wealth? Or are you willing to stomach wild market drops for total liquid freedom? Which hard path are you actually willing to walk?